The XRP Ledger is preparing to add something it has never had at the protocol level, a native system for lending and borrowing digital assets. The upgrade is called the XRPL Lending Protocol. It is built around two proposed amendments, XLS 65 and XLS 66. Together, they are designed to create single asset lending pools and fixed-term loans directly on the XRP Ledger. But there is an important fact to establish immediately. As of July 22, 2026, the lending protocol is not yet activated on the XRP Ledger mainnet. The code entered validator voting in January 2026, but the amendments still need more than 80% support from trusted validators for 2 consecutive weeks before they can become active. So XRP is entering the lending market, but the system is still moving through the network's approval process. The XRP Ledger already supports payments, token issuance, a decentralized exchange, stablecoins, and tokenized assets. However, placing an asset on a blockchain does not automatically make it productive. Traditional financial markets rely heavily on credit. Companies borrow working capital, market makers finance inventory, and investors lend assets in exchange for interest. The XRPL Lending Protocol is designed to bring part of that credit infrastructure onto the ledger. The first component is the Single Asset Vault, defined by XLS 65. A vault pools one type of asset from multiple depositors. Depending on its configuration, that asset could be XRP, an issued token, or a multi-purpose token. Depositors receive vault shares representing their portion of the pool. A vault can be open to the public or restricted to approved participants through XRPL credentials and permission domains. The second component is the lending protocol, defined by XLS 66. A loan broker manages the vault and works with borrowers to create loans using the pooled funds. The proposed system focuses on fixed-term, uncollateralized loans. This means a borrower does not automatically lock up more digital assets than the value of the loan, which is common on many existing decentralized lending platforms. Instead, credit checks, legal agreements, and risk analysis take place off-chain. Once the parties agree to the loan, the XRP Ledger records and enforces the financial terms, including the principal, interest rate, payment schedule, late payment rules, and default conditions. This design is aimed more toward underwritten institutional credit than anonymous borrowing. For example, a payment provider waiting for incoming funds may need liquidity immediately to complete outgoing payments. A lender could approve a short-term credit facility after reviewing the company's finances. The loan could then be issued and serviced through the XRP Ledger, according to the agreed terms. The protocol itself does not decide whether the borrower is trustworthy. That responsibility remains with the loan broker and the institutions involved. This is both a strength and a risk. Off-chain underwriting allows institutions to use traditional credit analysis and compliance procedures. However, the blockchain cannot guarantee that a borrower will repay an uncollateralized loan. The design includes optional first loss capital. A loan broker can place its own assets into the vault as a protective buffer. If a borrower defaults, some of this capital can absorb losses before depositors take the full impact. That can improve alignment, but it does not eliminate risk. If losses exceed the available protection, depositors can still lose money. The protocol also does not currently include automatic collateral management or liquidations. Unlike many DeFi platforms, the XRPL model focuses on credit origination and loan servicing rather than automated over-collateralized lending. So, what does this mean for XRP? XRP could potentially be deposited into a single asset vault, lent to approved borrowers, or borrowed through a lending facility. That could give certain XRP holders a way to put their assets to work instead of leaving them idle. XRP also remains necessary for transaction fees and account reserve requirements across the XRP Ledger. More lending activity could create additional transactions and network usage. However, the protocol will not require every lending pool to use XRP. Vaults may also hold stablecoins, tokenized assets, or other issued tokens. A successful lending market on XRPL could increase overall activity without creating equal demand for XRP in every loan. Native lending could make XRPL more useful for institutional finance, create new liquidity options, support tokenized assets, and allow businesses to manage working capital on the same network they use for payments and settlement. But there are serious limitations. The amendments are not active yet. Applications still need to be built, regulated operators need to participate, and real borrowers and lenders must choose to use the system. There is also technical risk. RippleX has reported that audits, a public attack-a-thon, red team testing, fuzzing, and formal verification uncovered numerous issues during development. Those reported issues were addressed, but the testing history shows why activation is being handled carefully. Legal requirements also vary between jurisdictions. The protocol can support permissioned participation, but businesses remain responsible for licensing, compliance, disclosures, and investor protection. My honest assessment is that this could become one of the XRP Ledger's most important upgrades because credit is essential to functioning capital markets. Payments move money, but lending allows capital to be reused more efficiently. At the same time, it is too early to call the protocol a success. It is not active on mainnet, there is no established lending volume, and there is no guaranteed yield for XRP holders. The most important things to watch are validator approval, the activation of XLS65 and XLS66, the first production applications, assets deposited into vaults, loan volume, defaults, and the amount of XRP actually used. The upgrade creates infrastructure, not guaranteed adoption. XRP may soon have a native role in lending, but the real test begins only after the protocol is approved, activated, and used with actual capital. This video is for educational purposes only and is not financial advice. Lending digital assets involves credit, liquidity, technology, regulatory, and loss of principal risks. Always conduct your own research before participating in any lending product.